Okay, guys, let's just start with. I'll just give you a brief update. I put in a few more. We are not using this file that often, but whenever I see, I put in a 3 more. This is for you guys who are those who want to add additional. Okay, guys, too much talking going on here. No talk. I've given you YouTube links to 3 interviews of people who have they have very important things to say about the market. So one is, these are people for, I don't know why I'm giving you all this, because you're not even doing the material that is being taught. But if you want to add to any of that, there's a guy called Ray Dalio, who's a very famous hedge fund manager. He manages one of the largest hedge funds. So anything you get by these 3 guys. So one is Ray Dalio, and then the other is Howard Marks, and then the other is, you can see the names in the, this is in your file where we put in all the random links, okay? So there's Ray Dalio, who manages a hedge fund, okay? The hedge fund is an alternative asset management vehicle. It's one of the largest hedge funds, Bridgewater. So you can just generally find anything on YouTube by Ray Dalio, and you can just watch those videos, okay? He's very knowledgeable, and in fact, I'll give you one of the videos specifically. But just find anything that this one he's talking about Argentina and Turkey and all those cases. But very knowledgeable person. All 3 are very knowledgeable. So read anything you have and use that name to search on YouTube and dig up anything. Okay. Howard Marks is, I'll just tell you a little bit about Oaktree, because you've studied value investing. Okay. So typically when you read, and I've given you some of those classic books to read, right? So most of the classic books on value investing, they would deal with value investing from an equity equity standpoint. Okay, so for the asset class that we call equities. Okay, so typically most of the discussions, the theory of value investing, it's all been developed with respect to equities. Most of the literature is on equities. So what Howard Marks runs a firm called Oaktree Investments. So what these guys do, they're actually what is called a distressed debt investor. So you can actually think of them as, they're value investors, but they don't operate in equities, they operate in debt. Okay, so when they see, remember, what does a value investor do? He buys when prices are below fair value or above fair value? Below fair value, right? When prices are far below fair value, then he will go in and buy. Okay, with the view that it will move back to fair value, right? So these guys do the same thing. Oaktree does the same thing. It's a very big investment manager, and they do the same thing, except that they do it in the case of debt. So they find bonds they wait till they find opportunities to buy bonds which are trading far below what they think is the fair value of those bonds. Okay, and so it's exactly value investing, but it's applied to debt, which is a little unusual because most of the value investors operate in equities. So Howard Marks is a very knowledgeable investor, and he also writes a letter. He writes a letter to his investors every once in a while. These are called notes. So you can read those notes also. You just go to the Oaktree website, pick up the stuff. Very, very knowledgeable people. You can learn a lot from these guys. And the third one is a guy called Jeff Gundlach, who manages one of the largest bond funds. Okay, so he also is a very knowledgeable person. He runs a company called Double Line Capital. So you can go to the Double Line website. He has these podcasts and research reports. So anything done by Jeff Gundlach you can read up. It's very, very knowledgeable. You learn a lot about what is going on in the market and how to look at markets. So these 3, I thought I'd just add these in your general sheet. You can follow up if you want for further knowledge. Okay, now let's go back to what we were doing. I just need to show you something I'm just going to open this. I'm just going to show you how, because the problem with this particular software that we are using is that it's not as high quality as the TWS. Okay, in the TWS, the order terminology, remember all these terms that we learned, order or market if touched, stop and all that, those are all classical and those are all perfect terminology. But on Oanda, what you will find is the charting is much better than TWS, but in many other ways they're not an optimal platform. So one of the things that they don't do right is the terminology that they use for orders. Okay, so I'm just going to explain to you in the context of, remember we've looked at 3 ways to enter the position. At market, worse than market, better than market. 3 ways to enter the position, and there are 3 orders associated. At market is which order? Market order. Okay, worse than market is what order? Stop order. Okay, stop or stop limit, whatever you want to use, but that variety. And better than market is limit order. Okay. Limit or? No. Again, you're making a mistake. Again, somebody asked me the same thing in the other time. Don't make this confusion, okay, guys? Let's get this clarified. Let me. Sorry. I'm just going to remove the. Or I think let me just pop out the chart. Okay. There is some confusion here still about. It just shows you how important the order types module is, but it's surprising that people are still confused. Now let's say MIT is only used. MIT is used for entering the order. Can be used for entering the order also. But the difference is, let's look at it this way: that if
Sir, under MIT, we consider that if the price reaches to a certain level, it will go down or it will go down.
Yeah.
That's why we use MIT.
Yeah, so normally actually MIT is used for exiting existing positions, okay? That's why, but you can also, if the view is there, I think strictly speaking, we can say that you can use MIT for the entry as well. But there's a difference between the difference in the view between MIT and limit is that in the case of the limit order, you don't expect a limit sell order or a limit buy order. You don't expect dramatic price movement after that particular price is reached. Okay, so if I want to buy euros at 114, okay, and I feel that the euro will go to 114 and it will hang around there for a while, there won't be any dramatic reversal, okay, then I would use a limit order, because the difference between limit and MIT is that the limit order guarantees if I give a limit buy order at 114, that means I know that it will be bought at the highest possible rate at which it can be bought is 114. Okay, it may be better than 114, but it will buy only at 114. Okay, highest possible rate is 114. Okay, but in the case of a market if touched, if I give a MIT order with 114, okay, it's a little unusual. But then what will happen is that order I would only place when my view is that the euro will drop very sharply to 114, and then very quickly it will rebound from 114. So there is if I give a limit buy at 114 in that kind of scenario, what might happen is, if my view is correct, it will go to 114 and it will maybe trade only once at 114, okay, and somebody else's order might be ahead of mine, and then it will never see 114 again. So if I give a limit buy order in that situation, it will not get filled. My order won't get filled because the system won't fill it if it can't get 114 or better, right? Okay, so that's why you give a market if touch to ensure that you get the execution. You have this scenario that it will touch 114, okay? So it's a very complicated view that you have. You have the scenario that it will sharply drop to 114, it will touch 114, but after that it will rebound very quickly. So that's why you're giving a market if touched order, because once that 114 touch happens, you want to quickly get in at any price. You follow the logic? Some people are still looking confused. You're clear now?
Yes, sir.
Okay. So that's why. So it's a different view, but generally what happens is, market if touched is not used on entry orders. It's used on exit orders generally, although theoretically there's no reason why you can't use MIT to enter also. Okay, so typically if you take that normal situation, then then the limit order would be used to enter into positions, also to exit from position, but the MIT would be used. So in this case, if you take limit order to buy the euro, you would place a limit buy at 114, and then once you have a long position, you might use a market if touch that if you say 118, it will go to 118 and then sharply drop, then you use a market if touch to sell. But I think it's better from a theoretical perspective if you think of it just based on your view. Okay, so the difference between the MIT and the limit order is really based on your view of how the price action is going to evolve. If you feel that the market will go to a particular level, just touch it and then sharply fall or sharply rise, then the MIT is more appropriate, okay? And you want to enter or exit the position at that once that scenario unfolds. Is this clear? Everyone's following? Okay. So, and then in the case of a limit order, when you expect more orderly price action, okay, it's not going to be dramatic, you just have normal price action, then the limit order is more appropriate because it ensures that you get the limit price. Okay, clear? Okay, so what was I talking about? Let's just... Okay, now what is going to happen here, there is a bit of a problem in terms of the three order types, okay? Let's look at this. If you just right click on this, now let's say that I want to okay, so let's say I want to buy the euro at 114, in which case this is I can just right click. You can have keyboard shortcuts also. F1 is help, F2 is buy at market, F3 is sell at market, F4 is buy limit, and F5 is sell limit. Okay, these are shortcuts, keyboard shortcuts. Otherwise, you can just right click in the area I want to buy at 114. So if I right click now, you can see here, maybe you can't see here properly. Maybe if I do it here, does it? No, it's still. Now you can see. You guys at the back, Sushant, can you see this? It says market buy, market sell, entry buy, and entry sell. Okay, it's a little bit. This terminology is not correct. Okay, it's using this terminology. Essentially, what it.
Yes, so it's showing the spot price. So
these are spot. These are spot charts, spot euro, spot foreign exchange. Okay, which is an OTC market.
So these prices are spot price.
Which prices? That entry buy at the rate. Yeah, it's just telling you based on what. Remember, I bought it at. I've clicked. I must have clicked at that point. You can pick the point. See, if I go to 113 and now it's just giving 112.95. It just looks visually at what point of the chart you have clicked. Okay, so if you want to place an order near 114, you go to 114 here, position the cursor here, then you right click, then it will give you a price which is close to 114. Okay, so the entry buy that it's placed is actually the entry buy is not the right order, but I've clicked the entry buy. Okay, it says entry order. This terminology is not correct. Okay, so you go by the TWS terminology. So what this essentially means is a limit order. Okay, in this situation, it means it's a limit order. So if you want to buy if you want to buy limit at 114 on the euro, this is what you would do. You put in your number of units. Okay, and then you put in the price. Okay, expiration. You can put it further out if you want. Okay, 3 months, just to be on the safe side, and then that whatever you can put, whatever you want. Okay, take profit and stop loss also you can enter. Trailing stop we don't need to worry about at this point. Did I discuss with you how you use the 7.1 to proxy the solution to 7.2 by moving the stop?
Yes, sir.
No, sir. No, sir.
What? I've discussed it.
No,
Yes, sir.
No? Okay, fine. So we'll discuss the trading stop when we do that. Okay. I thought I had discussed it, but anyway, never mind. And upper bound, lower bound also you don't need to worry about at this point. Okay. So, all right. So you can actually estimate what your stop is if you're going in and when you're going in. Okay. Now that's as far as the limit buy is concerned in this situation. Okay. Now let's say your view is so far everyone's following. The market order is very clear, so there's nothing to worry about. The market order is okay. Market buy and sell is okay. The limit order terminology on the system is not correct, so you have to just tolerate it. But in your mind, you should always have the IBTWS framework. That is the right definition of the orders, the right nomenclature also. Okay, so is this clear? Use that in your head, but this system you need to know how to operate. Now, so as far as entering at market is concerned, if I want to buy at market, all I do is I will just do F2, it comes to market order, okay, and I can just put in, and if you notice here the rate will keep changing, 115.28, 115.27, it keeps on changing because I've entered market order. So the system, this dialog box will keep on updating the market price, whatever the market price is by the time you enter your order. So it keeps on updating. So if you just press F2 for market order, you can just right click and choose market buy. Okay, if I want to do market, I can just choose market buy. That's one. Now entry buy, if I said, as I said here, if you want to do a limit, if you want to do a limit buy, you want to enter at a price more favorable than the current market, you just click here and you do an entry buy, and then you enter this part. Okay, this is for your limit buy order. Now even more complicated is actually the third situation where you want to buy at a price less favorable than the current market. Okay, let's take something realistic, which is what you're actually going to be doing. Okay, let's say that I feel that the oil price will come down even more. Okay, this is not actually okay, let me just do it this way. So let's say that your underlying position, obviously in this project, your underlying position is long. Okay, so you are concerned about falling oil prices. Now let's say that you feel that at this point now the oil price is not going to fall anymore. It's going to go. It's going to keep on going higher. Okay, so therefore you feel that at this point it has now already bottomed out, and it will keep rising 75, 76, all the way to 85, etc. So then obviously your preferred, basic plan is to sell the oil price. We can talk in terms of a basic plan and a contingency plan. Okay, so when you operate in the markets, whether you are operating as a hedger or a speculator, you need to think in terms of a basic plan and a primary plan and a contingency plan. Okay, you can call it primary, secondary, whatever you want to call it. Okay, so the contingency plan is what you activate if the main basic plan doesn't work out. Okay, so basically things start going wrong, what do you do? Okay, all right, so your basic plan obviously is to sell hedge oil at a much higher level. This is clear. Basic plan follows from your view. Okay, your preferred view is that oil prices have now bottomed out, now they're headed sharply higher. So obviously according to your basic plan, you're expecting to hedge oil at a much higher price than what you see now. Okay, that means you're planning to enter the hedge at a much higher price than what you have now, which is some 69.80 or something like that. Is everyone following? I don't know why everybody is looking blank.
Yes, sir.
Is this clear? According to your, yeah, so that's what you should say if you're not able to understand. So what I'm talking about now is just to understand this peculiar nomenclature of orders that they have here. Okay, so how would you operate in a hedging situation? How would you operate? Okay, if you're like an oil company trying to hedge its production, which is what you're doing here, similar to that. So you have this view, you look at this oil price chart and you feel now this oil price big decline from 77. Now this decline is over. That's your view.
It will rise again.
Now you feel that the oil prices are now headed straight up. This is your view. Okay. So obviously you will hedge according to your view. Okay. So if your view is that it's obviously going straight, high, up now. Okay, it's going much higher. Obviously you will not hedge at this point. You follow?
Yes, yes.
Does it make sense? Okay, that you don't hedge now because you think that prices are going to shoot up. Okay. So that's why I'm saying that your basic plan is to hedge at a more favorable price than the current market. Okay, it's to hedge at a more favorable price than the current market. Okay, so in that case, but what happens if so you will sell, maybe you have a limit order to sell at 85 or whatever. Okay, because your view is going to shoot up to 85 now. So that's fine. As if it works out that way, then it's fine. Okay, but what if it doesn't work out? Okay, if it doesn't work out, you need to have a contingency plan. Okay, if oil prices, instead of actually shooting up, if they start collapsing, then what will happen? Your underlying position will keep on losing more and more money. So you need to protect that at some point of time. Okay, so what you can look at is basically this. Then what you do is you have to have a plan. Now what is your view? Your view is that this is the, I'm just zooming in now. This price of 68.60, okay, roughly 68.60 is the, I can't read the far, I don't know if you guys can read at the back there. 68.60 seems to be the low, okay, right. So if this is your view that this is, or the low has already been made on the oil price, now it's shooting straight up. Now what happens if the oil price falls below 68.60? What does it imperil your view? Does it jeopardize your view?
You will lose money.
You will lose money, plus, but essentially what does it mean for your view? It means that your view is wrong. Is this clear? It means that your view is wrong, or the assumption. You can think of your view also as an assumption. Okay, your assumption was that oil prices have now bottomed and they are now heading straight up. Okay, and based on your assumption, you have taken a decision not to hedge at the current market. Right? These are the options available to you. You could have hedged at the current market, okay, or you could wait for a slightly better price, and then we'll come to the third part, which is you sell at a price worse than the current market. Okay, you hedge at a price worse than the current market. So first you take the view, and your view is such that this oil price movement has already bottomed out. Now it's going straight up. Okay, so you can think of the view also as an assumption. You have assumed that this long decline from 77 has ended at this, whatever this point was, 68.60. Okay, you have assumed that. Okay, and based on that assumption, your action has followed from your assumption. So therefore you have decided not to hedge at the current market, and therefore you're waiting now to hedge at a much more favorable price. Is this clear? Because in hedging you have the entry price decision still has to be solved. The buy, remember what we discussed in the previous class, that the buy sell decision does not need to be actively solved because it is automatically solved. Your underlying position is long, so in the hedging, as far as the hedging is concerned, you're always a seller because your underlying position is long. Okay, so therefore the buy sell decision, remember, connected to the decision problems. Okay, whereas in an active risk book, you have to actively solve the buy sell decision. You need to take a view on the asset, and if you think it's bullish, then you buy. If you think it's bearish, then you sell. Okay, but here the buy-sell decision is automatically solved because your underlying position defines the buy-sell decision. Your underlying position is long, so your buy-sell decision is always to sell. Okay, is this clear? Are you following?
Like you have given the example, like you have studied jet fuel, that the underlying position was in the jet fuel market, but the hedging position was in the other market of crude oil. But in the crude oil, you will hedge in the same market now.
No. One second. Yeah, in this case, you'll hedge in the same market.
Same market now.
Yeah. So
That
here.
is only applicable for jet fuel market, that we will hedge in the crude oil market because of its liquidity.
Yeah, that also you need not always do that, because you could also decide to hedge in the jet fuel market directly. You could take an OTC market hedge using a jet fuel swap. That is an option that is available, but that is not as liquid as crude oil futures. So you could also hedge in the jet fuel market. So for the purposes of this discussion, that jet fuel, crude oil, basis risk aspect, that aspect need not be brought in. Here we are discussing the current case, and we are discussing, yeah, you can understand, it's okay to bring that in because you are connecting the idea, which is a related idea. But here we are discussing only crude oil. So we are not discussing that question of which market. We are not discussing the question of which market to hedge in. We are discussing the question of the entry price. And I'm just highlighting again that the buy-sell decision is already solved automatically, but the entry price is not automatically solved. The entry price is basically, you see that in the hedging scenario, the entry price is what you're actively solving all the time, right? You are trying to decide at what price should I hedge, and that requires you to take a view on the market. Because here your assumption or your view is that the oil prices are going to just shoot up now. So obviously you would not hedge right now, because if they're going to shoot up, then you can hedge at a much higher price later on. Are you following?
Yes, sir.
Okay, so the decision follows from the view. That's why we have to be so focused on financial markets and understanding financial markets and learning how to navigate financial markets, because all decisions are based on views on financial markets. You have to take a view on particular markets, okay, on the particular market where you're operating. So now if your assumption is that prices have already bottomed and now they're going to shoot up. Now if prices fall below the 68-60 level, okay, if they fall below the 68-60 level, what does that mean? What does that say about your assumption?
Wrong.
Assumption is wrong. Okay. So now remember, logically, if you took a decision based on an assumption and now you find that the assumption is wrong, what should you do with the decision?
Stop, sir.
Yeah, you have to exit. You have to unwind that decision basically. If it is possible, you have to unwind the decision. Okay. In certain business situations where you have already started building a plant, you may not be able to unwind the decision, but you might have to try and sell it or something like that.
Hold the position also, if it has not followed that.
Holding the position is not logical. We have to act in a logical manner. This is where your formal training in finance should help you, or should play a part, rather than operating like many people do in industry. They just operate haphazardly. Oh, it's gone down. No, I want to hold on to my position. I don't feel like selling. This is not the way you should operate. You have to operate logically. All your actions must be logical. If you took a view and you said that the long decline from 77.10 has already ended at 68.60, that's a specific statement that you have made in terms of yours as an assumption. We can call that an assumption. Okay. So if you're based on that assumption, you have taken a decision to sell you had an option to hedge at market. Okay. But why did you not hedge at market? Because your view was, or your assumption was, that prices are going to shoot up. So obviously you'd be foolish to hedge at market if you think prices are going to shoot up. So they would go to $85, etc. So you could get a chance to hedge at 85. So why should you hedge now at 69.80, right? So that's your assumption. Now you have to operate in a logical manner. Okay, everything is that is the right way to operate. Okay, you can always decide to operate in a haphazard manner, but that is likely to lead to long-term problems. Many companies have gone bankrupt because they did not have a systematic hedging program. That's why they've gone bankrupt. Okay, if you have a systematic hedging program, you may have losses, but you won't go bankrupt because everything will be under control. Okay, all right. So you will have budgeted losses only. Okay, so the way to operate logically is that if your assumption has been invalidated, then a decision that you took based on that assumption should also be unwound as far as it is possible to unwind it. This is clear to everyone?
Yes.
Logical? Okay, so now what you have to do is, what was your decision? Your decision was not to hedge. Your decision was to refrain from hedging because you expected much higher levels. Okay, So if your decision was not to hedge, now you have to do the opposite of that. You have to unwind that, which means you have to hedge now. Okay, so that's why the way you should operate logically. Okay, if you want to operate logically, the way you should operate is you come in closer to this and you see whatever 68, 60 this level is. Okay, actually it's 68.71. Okay, 68.71 is the lowest level. You can actually use this cursor and find out what the low level is. So 68.71. Okay, now I'm just going to give you, now what do you have to do? Therefore, that means when you take a decision, you should already capture your decision, or your preparation should already reflect both the basic plan and the contingency plan. So your basic plan was to hedge at much higher levels, okay, because your view was that the price is going to shoot up, okay, but you also need to have a contingency plan in place which will protect you if your basic plan goes wrong. If the basic assumption goes wrong, then it should protect, you should have a plan to protect yourself. If the basic plan goes wrong, that is your contingency plan. Okay, so the other thing you have to do is, first you take a decision not to hedge, but as part of your contingency plan, you should actually have what kind of order at 68.71? Stop sell order, right? You should have a stop sell order. What will happen with the stop sell order is that it will get you into the short position. Okay, so whatever is, like, if your total position is 1 million barrels, you might want to leave it for 1,000 barrels or 5,000 barrels. On this platform, you can only trade for 1,000 barrels at a time. Okay, so you have to do multiple trades because they want to match it. But these guys are hedging. These guys are market makers. Okay, Wanda, they are actually, like, unlike IB, which is a broker, these guys are market makers. So they actually have to hedge their own position. So they have matched it to 1,000 barrels means one contract on the NYMEX. Okay, so that's why they're going to hedge themselves. So that's why they have put a limit of 1,000. They don't want to have more than one contract exposure at a time from one person. Okay, so what you're going to do is, so that's a limitation of this platform. Okay, on IB, TWS, you wouldn't have had this constraint. But anyway, so what you're going to do is you need to place a stop sell order. Now this is where I'm going to show you how this peculiar terminology works. Okay, so you have to enter an entry sell order. Okay, now this is a very peculiar terminology that they're using. Is actually your stop sell is also going to work like this. Okay, what is going to happen is entry order, you notice that it's a sell. You can see that. Okay, so 68.71 we saw. So let's say I have units of 1,000 units. Okay, 10,000 won't work. 1,000 units. So 68.71. Okay, so so there's 3 decimal quotes, third decimal up to third decimal. So 68. So what is immediately below 68.71? We have 68.79. Let's say 68.79 is immediately below this. Okay, so it's just like I'm saying that as soon as 68.71 breaks, okay, that means my view is wrong. So I need to enter my short position. Okay, I need to enter the hedge. Now see what happens here. Server has accepted the order. Now you see what the server is showing. Yeah, you can see that little order there.
Yes.
What does it say?
Sell order 1,000.
At 68.70. Okay, so now on a proper system, the reason I'm highlighting this method of entering orders on this particular platform is that it is actually not consistent with what I have taught you so far in terms of orders. This should have been accepted by the system as a stop sell order. Okay, but this is how you enter stop sell orders on OANDA. Okay, that's why I'm saying that operate like this only for the purposes of using OANDA and knowing how it operates, but don't make this your theoretical, don't bring this into your theoretical learning. Okay, the theoretical learning should be based on what you learned earlier, okay, which is the way the TWS operates. That's the terminology. Are you following what I'm saying here? Yes. That this should have actually been called by this should have been labeled by the system as a stop sell order, but actually they call it an entry sell order, which is not the correct way. Normally the market we don't.
Sir, how do you know that it is not a limit sell?
Because here what has happened is a limit sales, they are for them as far as they are operating. That's why they would have already sold it. If it was a limit sell, they would have already sold it. Okay, but because the current market price is higher than the limit sell, so this is the peculiar way in which the software operates.
So
they know that it's not a limit sell because it is below the market. Because the sell order is below the market, so they know from that logic, they know that this is not a limit sell. Because if they had accepted it as a limit sell, they would have sold it immediately. Because the current market is higher than your price of 69.79, 69.709. Is this clear to everyone? How the peculiar logic operates in Wanda? So this is not the correct terminology for orders, so keep that in your mind, but this is how you have to operate the software for the purpose of this project. Okay, so this is how your thinking should also be when you're running a hedging program. That you take a view on the market. Okay, for all decisions in finance, you have to take a view on the market. You take a view on the market, your view on the market essentially becomes an assumption. It is an assumption about how the market is supposed to behave. Is this clear? It's an assumption. And then you should also clearly place the advantage of operating from a technical method. Like again, we're going to use TA for technical analysis and FA for fundamentals. The advantage of TA is that you can operate in a very specific manner. If you make the specific statement, okay, you take a very specific view. You say that, okay, this downtrend is over. Okay, this downtrend from 77.10 is over at 68.71. Okay, you make a specific statement. You can always do that if you take a specific enough view. The advantage of TA is that it gives you you get very objective and very quick feedback from the market when your assumption breaks down. See here, if you make the statement that the decline from 77.10 is over at 68.71, okay, that means that if the price breaks below 68.71, your view is wrong or your assumption is invalid. Okay, so this is the advantage, according to me. One of the advantages of TA is that if you do it in a sufficiently intellectually honest manner, or not what Tanuj is saying, I want to hold on to it even though it has gone down. There's no logic in that. If you operate logically, in a highly disciplined manner, the advantage is that in TA, that the market gives you very quick and objective feedback. Very quick and understand what is happening here from a theoretical perspective. Because if you, as a general theory, in every realm of life, you can say that you have an assumption and you make some certain. Everything is based on assumption. Most of the things we do in life and business, everything is based on assumption. CCD opens a new outlet. Okay, that means what? They're assuming there's going to be a lot of foot traffic there. People are going to come in and drink. If they think there's nobody's coming here, no, why would they open an outlet? They've made some assumption that every day we'll get some 50 customers or whatever, 70 customers, right? So everything is based on assumptions. And then everything is uncertain in the future, so you don't know whether your assumption is actually going to come out to be correct. So the advantage in TA is that it gives you very clear, the market gives you very clear. Think of the difference here. Like if, let's say, CCD opens a new outlet, okay, assuming that we will have 70 customers every day and they are going to spend on average of 200 rupees, okay, on that, in that outlet. Now this is an assumption based on which obviously they expect this to hold out after maybe over a period of 6 months or 1 year. Now if, let's say, the bet is actually not working out, if people are not coming, do you realize how difficult it will be for them to understand and how much time it will take for them to understand that this thing is not really working out? Because they can't go on 1 day's activity or 2 days activity. They have to give it some time. They have to see for 3 months, 6 months, 9 months. Are you following what I'm saying?
Yes.
In a normal business decision, you can't really figure out, it takes a long time to figure out that my assumption was wrong. And usually that assumption is just what I said, that we are going to assume that we are going to have 70 customers in this shop and they are going to spend an average of 200 rupees per visit. Okay. Now these assumptions don't just fall from the sky. They are based on other assumptions. They are based on maybe another metro station was supposed to open nearby, or per capita income is going to go up by this much. Okay, middle classes the number of the people in the middle class will increase by so much. Are you following what I'm saying? These assumptions are based, business decisions are based on all these kind of assumptions. So actually you don't know at which part of the chain, okay, the assumption has gone wrong. Okay, so it's very difficult to figure out in the real world of business which assumption has gone wrong. Every decision is based on assumption, so the assumption is no longer valid. You should unwind the decision. But the problem in the real world is that it takes a lot of time in most business situations to figure out, to even understand that your assumptions are not working. It takes a lot. Are you following what I'm saying? You get the feel that to understand that your assumptions about GDP were not correct, your assumptions about inflation were not correct, okay, assumptions about industrial production was not correct. It will take a long time for you to figure out. Okay. So now the advantage of TA is that that would happen if you're using FA kind of analysis. Now what I'm trying to show you is something to understand when you're trying to choose between methods. Like many of you had this question, like Goel used to ask this question that should I use FA or TA? Okay, so one of the things you can look at, okay, that in TA, if you're sufficiently intellectually honest and you're disciplined, okay, the market gives you, because everything is based on price. Your view is also based on price, okay. So the market gives you instant feedback. As soon as your assumption breaks down, you get to know. Okay, so that's what I feel that because what happens is, remember what I told you about uncertainty. Okay, the problem in economics and finance, okay, in financial markets, I mean, as far as the economy is concerned, is the level of uncertainty is very high. This is not physics. So physics, we can send, now we are sending more probes to Jupiter and Mars and this and that. We can do all that. It may actually take 5 years to reach there, but we can actually predict how exactly the thing is going to move. Because the gravities of these planets, their orbital path, nothing is going to change. Okay, it's the same as what it was 50 years ago or 100 years ago. Nothing is changing. So that's why we're able to do all these wonderful things in physics, okay, or in engineering. But you have to understand that markets, the economy and financial markets, they're a totally different kind of animal. Okay, the level of uncertainty is extremely high. Okay, so most of the prediction that you're going to do, most of the prediction tools that we have, okay, most of them are actually effectively, as far as I'm concerned, they're effectively useless, because the level of uncertainty is so high, and it might as well just toss a coin and decide whether to buy or sell. It's almost that bad. Okay, so now the point is here that that's why what happens is, because the uncertainty is very high, okay, the focus needs to come down to what is called risk management. That is, what happens if your initial decision is not correct? How do you manage your risk? What is your risk management plan? Are you getting the flavor of this? Remember, I told you Lloyd Blankfein also mentioned this once. Okay, who is Lloyd Blankfein? Now you don't remember. Lloyd Blankfein is a retiring CEO. Now he's already retired. He's a retiring CEO of Goldman Sachs. So former CEO of Goldman Sachs. Okay, so he's a trader. Okay, he comes from a commodity trading background. So he was being asked about the economy and all that, economy and markets and all that. So in that interview, he mentioned that I focus not so much on prediction, but rather on managing the risk. Okay, so you make an arbitrary prediction. Okay, you can almost make an arbitrary prediction. Okay, or if you make a methodical prediction also, that's fine. But you have to have a very good risk management plan, because most of your predictions are going to go wrong. So how you manage your risk and how you manage your positions when the forecast does not go right, that is much more important in economics and finance. Okay, as compared to physics. Physics, you don't have to worry so much. The only thing that goes wrong is, maybe you had a faulty part, like one of the SpaceX rockets blew up. Why? Not because the technology was wrong. There's nothing wrong with their model or anything. Because one of the parts was faulty. So obviously, if you put in a faulty part, then if it passes quality control, then you're going to have problems, right? So the advantage that what I'm coming down to is that risk management is obviously very intimately connected to the idea of your assumption breaking down. Okay, remember, because everything is based on assumptions. All your NPV models that you have done, okay, all your project analysis, everything is based on assumptions. That there will be good sales of this particular product, so that's why we will have such high sales numbers. That's why the NPV looks good. So that's why you accept the project, okay? But those sales numbers that you put in, and those earnings numbers which come from the sales numbers, so the real uncertainty is really in predicting the sales. That's where the major uncertainty is. So all that is based on a bunch of assumptions. That's all it is, okay? Because you don't know what the future is going to be. It's all based on a bunch of assumptions. And the problem in those kinds of analysis, okay, is that it's very hard for you to even figure out when the assumption actually gone wrong. The assumptions may have already gone wrong, but you're not going to be aware of it until much, much later. And so what I'm saying is, therefore, risk management is very connected to the idea of breakdown of assumptions, and you should be aware that your assumption is broken down. Okay. So what I feel is one of the advantages of TA is that if you take a view on TA, the market gives you instant feedback that your assumption is broken down. Okay. So that gives you a head start in terms of managing your risk. If you know instantly that, and there's no confusion about it. Here there's no confusion, because this is an objective piece of information. The market price of oil is now below 68.71. This is objective information. Nobody can have an opinion about this. It is true. Okay. So the moment that is true, the market has already told you that assumption is wrong. So you get instant feedback. Okay, and that gives you a head start in terms of managing your risk. Are you able to get a sense of what I'm saying?
So you also told that in fundamentals, the information can be wrong, but in technical charting cannot be wrong. Fundamental.
Yeah, something like that you can say, because fundamental, the assumption, no, that is strictly speaking not, if you look at the inputs, okay, so if you look at the inputs that go into your technical analysis, the inputs can never be wrong, because the inputs are all price, historical price, this cannot be wrong, okay, this is always correct, okay, this is always correct. But in FA, what happens is, if you're working with GDP data, like GDP data, typically you get 3 revisions. Okay, so if you're working with the first revision of GDP data, okay, you're working with the first revision of GDP data or the first estimate, and you're using that as an input in a model, that input itself could be wrong, because the second revision and third revision might change that number. As you saw in the US in second quarter GDP, first it came out as 4%. I think first it came as 4%, then it came as 4.1, and now it has come down to come up to 4.2. Okay, so those are actually big variations in terms of that, if you look at the size of that number. Okay, so so this is what I meant. Even in inputs in FA, the inputs could change, and there are some measurement errors also. Even the third estimate of GDP need not be 100% correct, because there are measurement errors in GDP, statistical problems, all these kind of problems, inputs. Those relate to the uncertainty of inputs. But here I'm talking about another thing, which is the breakdown of assumptions. In TA, the advantage is that the breakdown of assumptions is immediately telegraphed to you by the market. You get the information, so you can really start to immediately manage your risk. And this is an advantage. Okay, so that's what I'm saying in terms of, it's a long lecture, but are you getting the feeling of what I'm saying? When it comes to choosing between TA and FA, this is one of the things you can consider. Okay, that this is good. So now you know what has to, going back to how I wanted to show you how to operate this particular piece of software, because the order terminology is not correct. So is everyone clear now? Okay, and we have also learned something new again, or we have refreshed this idea that you form a basic view on the market. Okay, your primary view on the market, that's like an assumption or a set of assumptions. Okay, and then if you are using TA, you can formulate a point on the chart below which or above which that assumption is clearly proven to be wrong. Okay, so if the assumption, and based on your initial assumption you took a decision, okay, and so if the assumption is wrong, the decision should be unwound. Okay, so you do the opposite. Okay, so that's why in this hedging scenario you have a very bullish view on the oil price, so your basic decision is not to hedge. In terms of entry price, you decide that no, I am not going to enter at market, I am going to enter at a price much more favorable than the current market. Okay, but if my assumption is wrong, I better have a plan to at least hedge myself at a price worse than the current market. Okay, which is based on your view. Then based on your view, you put a sell stop order at 68.709, that is just below 68.71. This is clear? So, and we have shown you how to place orders in O&M. So similarly, you'll know how to place a buy stop order. If you want to place if I want to place a buy stop above this, let's say at 72.60, I'm just going to see. So I will place an entry buy. Now I'm placing a buy stop, but it's going to be called an entry buy. What is the price level? 72.60. So I'll place, let's say, just 100 barrels. 72. Okay. This is clear? So this is accepted the buy order. Now it is showing you that there is an entry buy order at buy order 100 units at 72.60. So this is actually a buy stop, but it is treated by the system as a buy stop order. What is there so much talking going on? I don't know who is talking, but there's noises coming from this side. Okay, so 72.60 is, it's just stacked side. So is this clear? I just wanted to make sure that you know how to make the enter all 3 types of orders. Okay. Sorry? Validity of the order, you can check. Maybe there's you can set the defaults here under user preferences, trading. Under trading, you can default entry order duration 1 week. You can set it to 3 months also if you want. Okay, so there's a default setting. Every order will be valid for 3 months. Okay, so that takes care of our order entry. Okay, most of the other things are done. Okay, so let's So this part has already been covered in the previous class. I'm not covering it anymore. You can listen to the audio till the video. You can watch the video towards the end. So all these things have been covered. Okay. Now let's just briefly. I want to just cover before I go on to the next part. I want to just go through the cases, the case questions.
So in categories of risk, in credit risk, there was a statement, trade counterparty walks away from deal.
So that is under which category?
So credit.
Okay. That is under. Why is there so much talking going on? AA2 and Bola. No, I think I know AA2. Okay, who will write down? Okay, I can do it now. I don't want to waste class time, but Lakshay just write down AA2. No. I was watching. Somebody is talking here. I don't know.
But we are not talking.
Okay, fine. Okay, we'll give you the benefit of the doubt because since I actually did not see. But okay, let's have. No, I didn't actually see him. So some noise is coming. I need to have a dog or something in the class, which will go and bite whoever is talking, so that I'll know who is talking. We have 3 black dogs in the institute. Okay, guys. Now, what are the key? Sorry. First, I have to answer your question. You're asking about 130 is also too much. Okay, trade counterparty walks away from deal. So it's a good question to clarify this point. So credit risk, okay, when we are looking at risk books, mainly as I said, we are looking at market risk and credit risk. So in credit risk can manifest in 2 ways. One is that the borrower defaults, which IL&FS is not able to pay its loan or its interest installments. Okay, so borrower defaults. Okay, this can happen in consumer credit or wholesale credit also. So that's a clear-cut example of manifestation of credit risk. The other manifestation of credit risk is that if you look at a situation like this, let's say that you had done a deal. Okay, let's say you are, say, Deutsche London, and you have done a deal with Lehman Brothers New York. Okay, where you have sold them oil. You sold them, say, 10,000. You have sold them 10,000 barrels. Let's say it's an OTC deal that you have done. Okay, you have sold them 10,000 barrels of crude oil at 77.10. Okay, you've done a deal with Lehman Brothers New York, and now so Deutsche is selling and Lehman is buying. Now the price has dropped to this point, and at this point Lehman Brothers goes bankrupt. Okay, which means they're not going to be able to service their contracts. They don't have any money, so they can't. So whatever they were, so let's say that was a forward transaction. Okay, so this happens today, and this particular deal that you had done, okay, where you have sold them oil at 77.10, this deal was for 1 year forward. Okay, so now we will deduct Ayush. Now just write Ayush.
Yes, sir.
Ayush is again trying to become the champion on negative scores. So write down Ayush's score, Ayush's team. You have to do something about him, no? You need to muzzle him or something. Like all the dangerous, all these Rottweilers and all, they have muzzles there. So again, maybe we should put a muzzle on Ayush so he doesn't talk. So put down Ayush as a negative mark. Okay. So what were we saying? So let's say you have a deal which is 1 year forward. Okay, you have one year forward deal which you have done. So the transaction will be settled 1 year later. Okay, so you did the deal on which date? 4th of October. Roughly 4th of October. You did this transaction. You sold 1 year forward crude oil at 77.10 to Lehman Brothers. Okay. Now what happens is on 22nd of October, Lehman Brothers goes bankrupt. Okay, so that means they're not going to be in a position to honor any of their contracts. Okay, so now what happens? See, remember what you did on 4th of October? You wrote out a contract saying they sold 10,000 barrels to Lehman Brothers for 1 year forward at 77.10. Maybe that was a squaring of a position that you had. Maybe you were already long 10,000 barrels. Okay, I'm just giving an example. You had sold to square off that position. So you were long 10,000 barrels from before, you squared off that position by selling 10,000 barrels to Lehman Brothers one year forward. Okay, and you thought your position was squared off. Now remember that case that we did in lab? Jamal, AKS Jamal versus Mullah Dawood. Same kind of transaction, sale of shares. The seller delivers the shares, but the buyer refuses to pay. Okay, same kind of situation, this exact same situation. Buyer has gone bankrupt. So a problem of payment can arise due to two reasons. Either there is an unwillingness to pay, or there is an inability to pay. So if the counterparty goes bankrupt, then there is obviously an inability to pay. Sometimes people, like maybe in Malia's case, to some extent this is true. There's just willful defaulter. Basically, he has the money but doesn't want to pay. Okay, so so he's taking advantage of that, the separate entity rule, which is for the corporation. So the corporation doesn't have the money, but he has other funds. So anyway, so as a result of which now your situation is 4th of October, you thought you had squared off your long position of 10,000 barrels by making a sale of 10,000 barrels to Lehman Brothers, okay, for 1 year forward. But now on 22nd October, you discover that sale was effectively almost like no sale at all, because the guy is not going to be able to honor the contract. So that contract is now unenforceable. I mean, essentially, you can enforce the contract through the bankruptcy process, but effectively, it's going to take a long time. So it's almost like you don't have that contract anymore, which means the sale that you thought you had made, that you effectively, it's like you didn't make that sale. Is this clear to everyone?
Yes, sir.
Okay. So now now your long position, which you had maybe got at some other higher price, now you're still long. You're effectively long at 77.10 itself. Okay, you're long 10,000 barrels. That is, Deutsche London is long 10,000 barrels of oil at 77.10 itself. So this is what you call this is another example of manifestation of credit risk. Okay, where you have a contract on which there is a lot of profit. Okay, there's a lot of profit on this contract for Deutsche London because they have sold at 77.10 and the current market price is 69.80. So there's a lot of profit for Deutsche London. Is this clear? The contract on which there is a lot of profit. Okay, but then the counterparty defaults. That's when also you have another example of a manifestation of credit risk. Okay, because of the failure of the counterparty to pay. Okay, so credit risk is always a case of a failure of a counterparty to pay. Either it may be a failure to pay a loan, okay, which is what you see in Kingfisher and ILFS and all these cases, or it could be a situation where the failure to honor a contract, which is also something you're supposed to pay. You're supposed to pay for 10,000 barrels at the rate of 77.10. You're supposed to pay that, right? So failure to pay that amount according to the terms of the contract, that is also an example of manifestation of credit risk. But I'm highlighting these as two different kinds of sources of credit risk because the circumstances are quite different. The circumstances are quite different, okay, in terms of the way that the seller faces the risk. Is this clear now? Your question is clear? Yeah. Okay, so we go back to
the contract is made like the Deutsche Bank is selling to Lehman Brothers. The contract is made, the payment is not achieved.
If you want 1 minute, if you want to cancel these orders, you can just click and cancel. We'll just cancel these orders. These prompts also you can change. If you go into the default settings, if you don't want these prompts to come every time, you can knock off all these prompts. Okay, yes. What is the question?
The Deutsche Bank has made the contract with the Lehman Brothers New York. The contract was made, but the payment was not received.
Oh, because it's a 1 year forward deal. So that means the settlement will happen
on the day of execution. After 1 year. After 1 year.
Right. So transaction date plus 1 year. Settlement date will be 1 year forward. That's why you have a problem. If it's a spot settlement, then you have only 2 days of risk. So normally that is not considered very risky. Okay. So normally if you go into now some of you have gone into risk, but obviously 2 of you have got jobs in risk, but there is consumer credit risk. But the concept is quite similar. The concept is that typically if you're working on the wholesale side of the treasury and you're looking at risk limits you will see that the further out you want to go, if you want to do a 5-year deal with some bank, the limits will be much less. Okay, if you want to do a spot deal, the limits will be much higher. Okay, if you want to do spot, like right now there's a lot of questions about Deutsche Bank, about many of the Italian banks. Okay, there's a lot of questions about credit risk. But your spot dealing limits will be quite high, but your further forward, the limits will be much less. Are you able to see that? Because the risk of a counterparty going bankrupt over 5 years is much higher than it is over 2 days. Is this clear? So that's why the longer term limits will be much, the trading limits will be much less, because you don't want to be exposed. Okay, so we want to come down to now. Okay, I want to quickly cover the case questions. Okay, first question, key risk factors. Now we know what the key risk factors are. What are they? Look at the
So spot gold price.
yeah. Yes. What are the key risk
Spot
factors?
gold price, spot copper price, spot WTI oil price.
Okay. Then
Spot dollar yen rate, Aussie dollar rate, and 3 months lag.
now let's be more specific about this. Strictly speaking, what you should say. Let's try and answer this also here at the end. So here itself, just loosely, I'm just going to look at answers. Okay, so key risk factors, spot rates for those three, that is fine. Okay, now as far as the foreign exchange part is concerned, strictly speaking, remember these loans are, we have said there are like 10-year loans or something.
No, sir, they are not.
No, there is a speed. Aussie loan has what?
10 years maturity.
10 years maturity. Yen loan has 8-year maturity and a fixed interest rate. Both are fixed interest rates. Okay. Now, strictly speaking, what we have to say at this point, so the spot part is very clear about the commodity positions. Okay. Now, as far as the currency positions is concerned, we should actually say here we are at the bottom here, right? We should actually say 10-year. I'm just writing it here. FWD forward, everyone understands?
Yes, sir.
Okay, and similarly we should say here it is 8-year forward. Okay, this is what we should strictly say in terms of the key risk factors. Okay, but in terms of your management, if you look at this platform, then these rates that you see, this 112.72, okay, this stuff that you're seeing here, these are our spot prices. Okay, these are our spot prices. Okay, so you're managing the risk using the spot positions. Okay, using spot market, using the spot instrument, but actually the exposure is for forward. The reason we are doing it this way, there is also a logic in this. Partly we are constrained by the platform, but also partly because we have to learn a little bit about forward rates here. We will not know everything, but a little bit. So what we can say is that the forward FX rate I'm giving you all the terms that might possibly be used so that you know that if any of those terms are used, they are referring to the same concept. Okay, so or FX swap prices, simply FX swap prices. Okay, now if you remember, so this is what are we learning here now. At this point you're kind of just memorizing this. Okay, I'm not explaining the concept. We'll explain that later on when we go into all the discussion of products. So it's like I'm just telling you that to the north of the United States there is a country called Canada. I'm not telling you, don't know anything else about Canada, but you know that okay, to the north there is a country called Canada. So I'm just giving you some basic information which you memorize at this stage, and then we will discuss the details later. So the forward FX rate essentially is, I'll give you an example also. So let's look at let's look at the Net Dania page where we have the forward prices. And in dollar yen we'll see a very significant difference. So the spot dollar yen is 112.73, let's say. So if you see here on Net Dania, I'll just put this also into the link, although we have done it before. So first just let's read what we have written here. That the forward FX rate, okay, as I said, at this point you may not understand some parts of it, but just understand it as an overall statement. This forward FX rate, okay, the forward FX rate is derived by taking the spot FX rate and adjusting it. Adjusting means plus minus from the spot FX rate, adjusted by the FX swap points, okay, FX swap points, which we can call them FX swap points. Let me put inverted commas here so that we have, or FX swap differences. These are all referring to the same thing, okay? These are called FX swap points, or they are called FX swap differences, or FX swap premium discounts. Okay, these are more common terms, but this common you can also refer to them obviously as FX swap prices, okay? But this last part is the least common. Okay, so is this clear? So FX forward rate, if you want, you have to take the spot rate and just do a minus plus adjusted by the FX swap differences. Okay, so let's take an example. How would it work? If you see dollar yen spot is 112.73, if we take your it's taking a long time to open. I'll just use any spreadsheet. Okay, let me just use any spreadsheet and go here. Okay, so 112.73. Okay, and what I do when I look at the Net Dania dollar forward prices, what do you see? Let's say we are looking at 1 year forward dollar yen. Okay, this is too big. Yes? 1 year forward dollar yen. Okay, 1 year bid and ask is minus 360, is changing actually. So 363.5 and 361.5. So I'll take it as 363. Okay, midpoint of this is a bid and ask. I'm just taking it as a midpoint of the two. Okay, so you see here it says minus 363 and minus 3. So I'll take it as minus 363. Okay, so see what I'm doing. Now this is 1 minute. That we'll come to later. That we can't cover now. Okay. Right now I'm just teaching you what is some basic stuff. Okay. So it is minus 363. Okay. So it is 363. We'll just write as 363 pips. Okay. But if you, these are given in, these are all contextual knowledge. Okay. These are quoted in pips. Okay. So I happen to know that. So I'm going to divide it by 100. 1 pip is. In the case of dollar yen, 1 pip is the second decimal point. Okay, so 0.01. So 363 pips, what you saw there, that price, that 363 price which you are seeing here, this is 363 pips, which means because the pip in dollar yen is the second decimal, 0.01. Okay, that is the convention. Okay, in the case of euro, the pip will be fourth decimal, or sterling, or those cases. Dollar yen, euro yen, those yen cases will be second decimal. Okay, now this is not conceptual, this is just knowing about it. So I divided 363 pips means 3.63 if I'm going to quote it on the same basis as the 112.73 spot rate. Okay, so you have the spot here. I'll put this in your spreadsheet later on. Okay, swap. Okay, this is the swap adjusted. Okay, that is 3.63. In terms, if I want to now that it says minus, okay, and we have other ways to figure out even if the minus wasn't there. So here what will happen is now the forward is going to be, I'm going to just take this 112.73 minus, this is going to be the forward. Are you following? Is the font size big enough at the back for me? You've seen how the forward rate is derived? Okay, it is derived by just adjusting the spot rate by the FX swap difference or the FX swap points or the FX swap premium discount. Okay, in this case the dollar happens to be at a forward discount. Okay, the forward discount, what that means is that the forward rate is lower. The forward rate is lower. Okay, if we say that the dollar is at a forward discount against the yen, okay, in the foreign exchange markets, then what that means is that the forward price of the dollar is lower than the spot price. Is this clear? Okay, and if it was a forward premium, then this would have been something higher than what it would have been higher than the spot price. Okay, so that's why they are called FX swap premium discounts. Now we'll come to, there's a lot more logic behind that, a lot of concepts to be learned there. But now at this point we are only just discussing this question. Because we were just discussing this question in the sense of what we are saying, strictly speaking, when you look at a book like that, because these loans are payable, one is payable 8 years from now, one is payable 10 years from now. Okay, so obviously if the forward FX rate consists of the, or sort of is composed, I mean it has two components to it, the spot rate and the swap difference. Okay, so the total forward FX rate could change due to change in either change in the spot rate or change in the swap difference. Either of the two components, if they change, it will change the outright forward rate, the forward FX rate. Is this clear? This is just mathematical, because you have A plus B is equal to C. So then C can change whether if A changes or B changes. Either way C will change. So, so that's why we say that the exposure or the key risk factor in this case is the 8-year forward dollar yen and the 10-year forward Aussie dollar. Okay, so that's why we said in the case of the two, I have not written down the answers to the first three, so that is spot. Okay. Okay, is this clear to everybody now?
Yes.
Little bit, you're not expected to understand why it is minus, that all we'll do later. Okay. But essentially this, I can just tell you briefly, this is at a forward discount because US dollar interest rates are higher than yen interest rates. Okay, there is a principle called covered interest parity. You can read about it in advance in your book. You have a blue book given to you, Shapiro Moles. Not been given to you? But your course is almost ended. I have already recommended this textbook at the beginning itself.
Which one?
Shapiro Moles, and there's one Jayanto Basu or some Indian author also. International Financial Management is the name of the book. You haven't. So that means you guys got only one textbook for IPM.
Yes, yes.
Okay, then I'll tell Lalita why she's not given this textbook. Because I had already given the name much before. We have to give the names much earlier.
So very long.
Okay, alright. So is this clear so far, guys? Now what will happen is, one sec. As I said, A plus B equals C. So C can change either if A changes or B changes. But in practice what happens is, this stuff, if you observe it on your own time, if you see it, okay, don't get restless, there's still almost 10 minutes. Ishan is packing for the last half an hour. Okay, now if you notice, in fact, if you observe this throughout the day, you will see that the forward FX the FX swap points, they are much less volatile than the spot FX rate. You can confirm this for yourself, but I'm just telling you, okay, that the forward FX points, okay, the FX swap points, they are obviously moving. Can you see that? They are changing. Are you able to see that they are changing or not? It used to be 363, now it has come to be closer to 361 midpoint. They are changing, right? They are changing because they are derived from interest differentials, okay? Euro deposit interest differentials. So as those change, they will also change. These are not static, but they change much less violently than the spot FX rate, okay? The spot FX rate movement, you can see, if you want to see how dollar yen moves, you already may have some idea. Okay, if you look at 1 week movement of dollar yen, it's quite a lot of movement. Okay, so and earlier also you will see, if you will see long-term charts. So the spot FX rate moves. So the bottom line is, it's the same thing. Actually, those swap prices, FX swap differences, those are actually spread positions. If you have a position in the FX swap, that's a spread position. Okay, and if you have a position in the dollar yen spot, that's an outright position. Okay, so remember what we said about the relative volatility of outright versus spread positions. Which is more volatile or which is more risky? outrights, right? So the outright positions are more risky because those rates move around much more. They are much more volatile, okay? So the FX, so this is basically why you can actually effectively manage a forward FX position by just hedging in the spot, okay? There are some cash flow issues which we are not going into now, but effectively what that means is A plus B equal to C, but A and B are not equally important. Actually the spot FX rate is much more important. In determining the forward FX rate, okay, the changes in the forward FX rate, the spot FX rate changes play a much bigger role because those things move around much more as compared to the FX swap points. This stuff moves around much less, okay? You can see dollar forwards. This stuff moves around much less. FX spot rate will move around much more. So if you have a forward FX exposure, it is sufficient to be able to manage the spot component of the exposure. Okay, and then there's a cash flow issue which you take care of. We'll discuss it later. But if you take care of the spot, just focus on the spot price and manage your position on the spot with respect to the spot rate, you will be able to sufficiently cover your forward foreign exchange risk. Is this clear? Okay, so that's why we manage it through the spot, because it is much less volatile and much more volatile. Okay, is this making sense? Some of the material I've not told you. But are you following the basic structure?
Yes, sir.
Okay, so that's why, although you have to say in terms of your key risk factors, strictly speaking, you have to say it is actually 8-year forward dollar yen, 10-year forward Aussie dollar. But in terms of the way you manage your project, you are actually going to be operating in the spot market. Okay, and you've learned a little bit about spot rates and FX swap points. Okay, next question. What are Magma's underlying positions? Already been covered with you. All done. Okay, decision problems. This has also been covered. First 3 questions have all been covered. Okay.
That's all for today.
1 minute. It's not all. There's still a lot of time. We have to cover many things. Okay. So we have to cover now. What we are going to go into is your coverage of. Because we need to cover these elements, all the, so for your own knowledge of, now you'll find these notes, please make sure you read these notes at the end of this.
We have not got.
No, what not got? It's there at the end of your firms, functions, okay? Below your OTC markets versus ETM, okay, you have all these notes. We are going to discuss all this just to make sure that you have, we are going to move into the financing part. The second part of IFM is basically, the first part is risk management, second part is on capital raising. Capital raising or financing basically, okay? So these are the 2 most important roles of a CFO, managing risk and raising capital. So we're going to move into that and then we are going to cover these elements. Okay, let me start on it already today. Well, somebody's saying in a very low, there are 7 minutes left.
No, sir.
6 minutes left. 1 minute, 1 minute. Let's start quickly. We don't have time. We are very tight on time. 1 minute. No, I don't owe you anything. You owe me. You owe me. Okay. Alright, so is this better now to do it in the classroom as opposed to a finance lab?
Yes, sir. No, sir.
No, but actually it's better for me. I can keep an eye on who's talking. It's harder to keep an eye on who's talking in the finance lab.
We can't keep an eye on this.
Why?
Sir, it is very difficult to see over here, sir.
Why?
Finance lab matters.
So because of the size of the project.
No, but I think it's a little odd. It's a little odd to do it in the finance lab because I'm also not able to see you guys. So anyway, we had some sessions there. Let's do some here as well.
Sir, 3, 5 sections.
What?
5 sections are only.
Yeah, so we'll do those here until we can reconfigure the lab. What I've learned clearly is that we have to reconfigure the lab to bring the projector so I can stand in the front part and operate my PC. So I have to bring that projector cable all the way to the front. That needs some work. Okay, guys, this sheet I'm going to put into your folder. Okay, and this is connected to the notes as well. Remember when we started out, we started looking at the landscape of the financial services industry. So since you're doing a major in finance, you have to understand first what people guys see. You will have this problem. People use all these terms like investment banking without knowing what it actually involves. Okay, so you need to learn the classical terminology, understand what these different firms, what they do, what are their functions. Who's talking here? Still too much talking going on. Maybe it's harder. Maybe we'll go back to the finance lab. Maybe it's easier for me to see who's talking because the guys they are unsuspecting, right? They think that I don't see them. Here, whenever I turn, I'm not able to see who's actually talking. Okay, let's see. We'll do one more class here, and then we'll see. Okay, so the first thing you have to study this format, okay, and start reading the part which is in your notes in this part of the notes, this file below the ETM OTCM part. Okay, what are we going to cover here? Okay, first is depository financial intermediaries. Okay, I'm going to go through them quickly because we need to spend some time on capital raising. Banks. Okay, as far as we are concerned, we understand this to be banks. Okay, so why are they called financial intermediaries? Because you have three types of people. You have savers. Okay, savers are depositors, so let's call them depositors. Okay, you have depositors, you have banks, and then you have borrowers. Okay, so depositors can be both natural and artificial persons. Could be companies, firms, etc. Could be individuals. Depositors, they put money in the bank. Okay, then the borrowers also could be both individual. We can just the correct way to refer to it is to say natural and artificial persons. Okay, because you can have consumer credit like credit cards, bank, housing loan, student loan, all these kind of things. These are natural persons. And then you have lending to companies like ILFS, those are artificial persons. Okay, so the correct way to define the entities are natural and artificial persons on both sides, as depositors and as well also as borrowers. Okay, and in between you have the banks. Okay, so that's why are they called intermediary? Because the bank is standing, so it's not going directly, the money is not going directly from the depositor to the borrower. It is going through the bank.
Yes.
Okay, so that's why the bank is an intermediary. Okay, it's a financial intermediary because financing is involved. Okay, and it is a depository financial intermediary because it is taking deposits. So remember these terms. You have to remember the terms correctly. Don't talk in a loose manner. These are depository financial intermediaries. There are others who are not depository intermediaries, but they are financial intermediaries. Okay, they are depositories because they take deposits. Okay, so the depositor is just lending money to the bank directly. So these are all, there are two principal to principal transactions happening here. The depositor versus bank is a principal transaction, principal to principal. They are depositing money with the bank. And then the bank to the borrower is also a principal to principal transaction. Is this clear? There are two principal to principal transactions here, and there is financing going on through this mechanism. Okay, so that's why banks are called depository financial intermediaries. Okay, and what do we have? We have 2 minutes. 1 minute and 20 seconds. Okay, so this is commercial banks. I'll just give you, and then we have non-depository. Okay, so you understand all this. Okay,
Yes.
make sure you read all this. Under NBFCs, I've given you a hyperlink to the RBI FAQ on NBFCs if you want to read more about our local market. Okay, that is not so important for theoretical factors, but more to know the Indian market. Okay, and what the RBI regulations are. Okay, so you have to study all this stuff, and then we'll come back and we'll quickly discuss this. Then we'll move on to financing. This will help us to understand financing also. Okay, so I'm giving you a grace of a few seconds. Okay. Good. Okay, so you can go now. For Usain Bolt, this is a lot of time. So I'm giving you a lot of time. Okay, anybody has any technical questions before I close the recording? Question is technical. Yeah.
Can a person be an hedger and an investor at the same time? Like you were saying, the fund manager of the company is the
Investor is not a term. Investor is not a term that applies relative to the hedger. Either you say hedger, you say it as a hedger or a speculator. Don't say investor. Investor, that's actually like a layman's term.
audio I was listening, like
What you should use is the word speculator, not investor. So you can't be both at the same time.
Current market price of my equities are $100.
You have bought.
Yes, I have bought it at $100.
Okay.
No, I have bought it at the price. Current price is $100. Okay. So I place an order of MIT of 105.
To exit at a profit.
The position. Yeah. So if the and the price touches 105, so and then it comes back. So the entire position will be executed at 105, or then I will become market order and will perform like a
It depends what type of order did you leave. What type of order did you leave? Debit order? MIT. If you leave an MIT order at 105,
Yes, sir.
okay, and the market is at 100,
Yes, sir.
then if the market trades at 105, then the system will activate a market sell order. So whatever is the next price,
So it will become market order.
it's a market order. Because if you have left market if touched with a parameter of 105, then as soon as the market hits 105, the order is activated and the system will release a market sell order. So whatever it's the next price, it will sell.
Whether it go 106 or 104,
Whatever, any price, market price.
But if like in case of limit orders, it will be generally more than 105.
It has to be.
It has to be.
If you have left a limit order at 105, then when the bid goes to 105, okay, then the system will try to sell it at that bid. 105 or better.
Thank you.